Hi all, welcome back to my channel World Truvira. Today's topic or discussion is in detail info on mutual funds. This is continuation to my earlier discussion on mutual funds. Mutual fund is one of the investment options which is available for everyone with better returns for all their life goals aligned with both long term and short term open ended or closed ended funds like equity linked equity funds, debt funds. One should always invest in diversified assets providing one of the asset classes in mutual funds. Coming to the mutual funds, we should see certain parameters before investing into mutual funds. Diversification by mutual fund houses into stocks, bonds as per their investors and investment options choices. Ensure those fund managers are professional and well versed in managing the funds. Liquidity is key. Economies of scale is bigger the fund, better the fund houses. Types of mutual funds. Equity funds invest mainly on stocks. Debt funds invest on government securities and bonds. Hybrid funds are balanced one investment in multi-cap to reduce risk and give better returns. Index funds tracking indices long run very good. This is a basis of index or Sensex. In short run market conditions may affect, while long run very beneficial since market go up eventually. Sector funds specific industries or sectors. Example defense, infra, etc. Exchange traded funds, ETFs, recent days becoming popular in especially commodities, bonds, currencies, etc. Liquid funds, short term, when we require these funds, say 3 months to 6 months, this will be invested into commercial papers, treasury bills, competitive and gives better than saving account returns. Tax saving funds called ELSS, minimum lock in of 3 years and above to get income tax benefits under ITC. Benefits, they invest into diversified portfolio as per our chosen options and type. Low risk to moderate risks. Some of the schemes carry high risk but higher returns than FDs with inflation beaten returns. Potential for high returns as per your risk appetite. Liquidity, very fine liquidity, except tax saving schemes, having some lock in period. Convenience options available like SIP with minimum 100 rupees upper side, no limit. Even lump sum options are available. Professional management, they manage by experienced managers and fund houses. Regulatory oversight, market regulator like SEBI. Key things one should know: net asset value (NAV) will increase or decrease basis of equities, market conditions. Units will be the same. Expenses ratio, units purchased remain the same with you. Price of the units based on the NPA may go up or may go down based on the market conditions. Expenses ratio, we need to know what is expenses ratio for those funds we investing normally. This should be less than 1% or at 1%. Load, entry and exit fees. Entry load, SEBI abolished in 2009, but investors need to pay distributor commission upfront directly. Exit load, most of the fund houses charges if investors exit within 1 year, some will charge at the time of exit. ETF and index funds normally don't charge any exit loads. Dividend distribution tax, I suggest to buy regular growth options so that dividend earned are reinvested. Capital gains tax, as we discussed earlier, if we take within 1 year our invested money back by selling the units, we have to pay STCGs, short term capital gain of 20%, and after 1 year 12.5% long term capital gain LTCG up to 1 lakh no tax for the long term capital gains. I mean, in a short term capital gains, whatever you are sold, you have to pay those. Investment types available: systematic investment plan, SIP, monthly lump sum investment. This suits for all. Whenever additional funds available can be used to invest. Value investing, growth investing. Investment opportunity: online, offline, mobile app and trading account platforms. Here are the detailed responses. Trading account platforms. Here are the detailed responses. Strategies: investment should be goal based with regular investment and for long run. Invest in tax efficient funds. Example: index funds. Hold investment for over a year to benefit from long term capital gains. Balance equity and debt investments. Consider tax saving funds like ELSS if required. One, otherwise go with equity mutual funds and index funds. If you are near to retirement or retired and conservative looking for a safety, investors go for a debt and bond funds. Investment horizon. Investment horizon refers to the time period for which you invest. Mutual fund suits short term less than 1 year, liquid funds, ultra short term funds, mid term 1 to 5 years, short term debit funds, balanced funds, long term 5 years plus, equity funds, hybrid funds. Consider risk tolerance. It varies depending on one, risk taking ability. No risk takers means it suits debt funds or bond funds only, not to go with the equity funds or hybrid funds. Financial goals like education, buying home or down payment for house purchase, children higher education, own or children marriage, retirement and post retirement requirements. Typical investment horizons: emergency fund 1 to 3 months, down payment 1 to 5 years, retirement 10 years plus, better starting as early as possible. Here are the detailed responses. Assessment of future financial needs, risk associated with it. Risk assessment helps determine your tolerance for market fluctuations and potential losses. Factors influencing risk tolerance. Investment horizon: see how much one can save and invest. Every 6 months you increase it 5%. Financial goals should be reviewed regularly. Accordingly, investing should be aligned. Income stability: the investments in mutual funds will create regular income streams in case of any issues in your career and job losses situation. These funds one can take loan. Expenses requirement: planned or unexpected. Personality traits: never withdraw for your lifestyles or wishes wants. Risk categories: conservative, low risk, moderate, medium risk, aggressive, high risk. This based on your risk appetite, you have the returns also like that. Portfolio regular review once in 6 months to year and rebalancing non-performing assets to switch over to performing assets. Portfolio rebalancing: maintain your target asset allocation, ensuring risk management, optional returns, alignment with financial goals. Rebalancing strategies: periodic rebalancing, example half yearly or annually. Threshold based rebalancing, example 5% 10% deviation. Tax efficient rebalancing, responding by adding more money whenever possible or when markets are down to get more units. Comparison between close ended and open ended mutual funds. Close ended mutual funds: fixed number of units issued, listed on stock exchanges, and are traded like stocks. Investors can buy, sell units on exchange. Fund managers invest. Fixed corpus. Maturity period 3 to 5 years. No new investment or redemption allowed. Open-ended mutual funds. No fixed number of units. Units created and redeemed continuously. Investors can buy, sell units directly from AMC, asset management company. AMC's means no maturity period, new investments and redemptions allowed daily basis. Key differences: flexibility, open-ended funds offer more flexibility, liquidity, closed-ended funds trade on exchange, providing liquidity. Investment style, closed-ended funds have fixed corpus, open-ended funds adopted and keep on changing. You can always entry anytime and exit anytime. Maturity, closed-ended funds have maturity, open-ended funds don't have any maturity period. You can anytime you can do that by buying or selling. Unit capital, closed-ended funds have fixed unit capital, open-ended funds variable. Advantage of closed-ended funds: fixed portfolio composition, disciplined investment approach, potential for higher returns, tax efficiency. Disadvantage of closed-ended funds: limited liquidity, fixed maturity period. Advantages of open-ended funds: flexibility in investment and redemption, no maturity period, adaptability to market changes, liquidity is high. Disadvantages of open-ended funds: potential for style drift, higher expenses ratio, market volatility, impact. Choosing between closed-ended and open-ended funds. Consider investment horizon, risk tolerance, liquidity needs, investment goals, market conditions. Overall prospective, mutual funds are best available option for low to moderate risk takers. The tax deferred long-term investment strategy for financial needs and goals with inflation beaten returns. At least keep investing 7 to 10 years with XIRR, extended internal rate of return, used for regular SIP, multiple cash flows. For high risk takers, equity shares are generally considered as a first option, as we discussed earlier. To mitigate risk, even who invested in equity shares should also keep some regular investment in mutual funds. All the best for investing journey in mutual funds. Signing off, MVVS Reddy, World through Veera. Please like, share and subscribe my channel for more informative contents. Thank you everyone.